I need to search for the most recent information about Trump, tariffs, Europe, and Davos to provide an accurate current analysis. When you watch markets react in real time to geopolitical noise, the immediate movement tells you almost nothing about the structural damage already embedded in the system. The headlines out of Davos this week captured exactly that dynamic. Trump threatens tariffs on 8 European nations over Greenland. Markets plunge. Then Trump pauses the tariffs after discussions with NATO leadership, and markets surge. The S&P 500 jumped. Commentators celebrated the taco trade. Trump always chickens out, and the financial press framed this as resolution. But that interpretation fundamentally misunderstands what just happened. The damage from this week isn't measured in tariffs that didn't get implemented. It's measured in trust that can never be restored, investment decisions already altered, and systemic fragility permanently baked into global economic architecture. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The immediate facts are straightforward. On January 17th, Trump announced 10% tariffs on Denmark, Finland, France, Germany, the Netherlands, Norway, Sweden, and the United Kingdom, set to take effect February 1st and escalate to 25% by June unless these nations supported his acquisition of Greenland. Markets dropped sharply. European leaders held emergency meetings. The European Union froze its trade agreement with the United States. The deal negotiated at Turnberry in July 2025 that capped EU tariffs at 15%. French President Macron pushed for activating the anti-coercion instrument, Europe's trade bazooka. German automotive stocks fell over 2.5%. LVMH dropped 3.5%. Then, on January 21st, after meeting NATO Secretary General Mark Rutte in Davos, Trump announced he was pausing these tariffs based on reaching the framework of a future deal. Markets soared. Crisis averted. Except it wasn't. This is precisely the pattern that destroys wealth structurally rather than episodically. The issue isn't whether specific tariffs get implemented. The issue is that the threat mechanism itself has fundamentally altered the risk premium associated with transatlantic economic integration. Every European company making investment decisions about U.S. market exposure now operates with a different probability distribution. The United States has demonstrated repeatedly that trade agreements are not binding commitments, but temporary truces subject to unilateral modification based on unrelated geopolitical objectives. When the president threatens tariffs on NATO allies because they won't support his acquisition of an autonomous Danish territory and links this to his displeasure at not receiving the Nobel Peace Prize, traditional frameworks for calculating political risk have completely broken down. Consider what happened from a structural incentives perspective. The Turnberry deal represented months of negotiation. It established a 15% ceiling, more than triple the previous 4.8% average, but still a negotiated outcome both sides could work with. The European Commission described it as restoring stability and predictability. 6 months later, that stability was revealed as entirely illusory. The deal hasn't been formally ratified, and it's already functionally suspended because the same administration that negotiated it threatened additional tariffs over a completely separate issue. From a game theory standpoint, this teaches every rational actor that formal agreements with the United States carry no binding force. The credibility of American commitments, foundation of the post-war economic order for 75 years, has been systematically destroyed. The historical parallels are not subtle. In the 1930s, Smoot-Hawley raised tariffs to record levels, but the real damage wasn't the tariffs themselves. The real damage was the retaliatory spiral and collapse of international cooperation that followed. Trading partners imposed their own tariffs because political imperative to respond overwhelmed economic rationality. Global trade volumes collapsed roughly 66% between 1929 and 1934. What made that devastating wasn't the initial shock, but how uncertainty became self-reinforcing, Businesses couldn't make investment decisions because they couldn't predict the policy environment. Capital fled to safety rather than seeking productive deployment. Economic contraction fed political extremism, which further undermined cooperation, which deepened the crisis. We're watching a structurally similar dynamic unfold, accelerated by modern communication velocity and global supply chain interconnectedness. The World Economic Forum released data this week showing global supply chains have entered what they term structural volatility. In 2025 alone, tariff escalations reshuffled more than $400 billion in trade flows. Container shipping costs increased 40% year over year, not from temporary bottlenecks, but from fundamental uncertainty about routing and trade policy. Manufacturing output across advanced economies is growing at its weakest pace since 2009. More than 3,000 new trade and industrial policy measures were introduced globally in 2025, more than 3 times the annual level a decade ago. Three-quarters of business leaders now prioritize resilience investments over efficiency, which means building redundancy because they can no longer trust framework stability. This shift from efficiency to resilience represents a massive hidden tax on the global economy. For 4 decades, the dominant paradigm was global optimization. Manufacture components where labor costs were lowest, assemble where logistically efficient, maintain minimal inventories through just-in-time systems, leverage comparative advantage ruthlessly. That entire model depended on stable, predictable policy where trade agreements were durable and shipping routes secure. When that stability disappears, companies carry higher inventories, maintain redundant suppliers, build geographically diversified capacity, accept higher input costs for lower variance. Every adjustment reduces productivity. Every adjustment is permanent. Efficiency gains of recent decades are being systematically reversed, not because technology regressed, but because political risk became unmanageable. The DP World Survey of 3,500 senior supply chain executives found 53% expect high or very high policy uncertainty in 2026. 90% expect trade barriers to rise or remain unchanged. Half forecast moderate or sharp cost increases across shipping, transport, labor, and compliance. Their strategic response tells everything about the new equilibrium. 51% are diversifying suppliers, 44% are increasing inventories, 36% are friend-shoring production. These aren't temporary adjustments. These are structural modifications to global value chains that will persist regardless of what happens with any specific tariff. The damage extends far beyond immediate disruption to European exporters. Consider the signaling effect to every nation observing these dynamics. Canada celebrated a strategic partnership with China last week, explicitly responding to U.S. tariff uncertainty. The EU finalized its Mercosur deal with South American nations at precisely the moment U.S. reliability was being questioned. Latin American exporters are actively strengthening ties with China because dependence on U.S. market access carries unacceptable political risk. This is exactly how hegemonic systems fragment. The dominant power doesn't lose position through military defeat. It loses position by demonstrating that partnership carries too much volatility to be worth the strategic risk. What makes this week particularly insidious is that the tariff pause will be interpreted as evidence the system is working, that cooler heads prevailed, that diplomacy resolved the crisis. That interpretation is catastrophically wrong. What actually happened is Trump demonstrated he can unilaterally impose massive economic costs on allied nations for reasons entirely unrelated to trade policy, force emergency European leadership meetings, freeze a major trade agreement, tank stock markets, then reverse course based on a vaguely defined framework not made public. Treasury Secretary Scott Bessent told markets to take a deep breath, that everything would be fine. Commerce Secretary Howard Lutnick said trade deals with Europe are durable and stable, but durability and stability cannot coexist with the demonstrated willingness to threaten their destruction over unrelated diplomatic disputes. European Central Bank President Christine Lagarde said at Davos that Uncertainty is the enemy of growth. She's correct, but understating the magnitude. This isn't temporary uncertainty resolving when negotiations conclude. This is structural uncertainty about whether any negotiated outcome has durability. Even if the Supreme Court constrains Trump's tariff authority, which some analysts expect, the damage from demonstrating this policy volatility persists. International investors already learned the United States cannot be trusted to maintain stable commitments. That lesson doesn't get unlearned because a court ruling limits future authority. The risk premium has been repriced. Alternative supply chains are being built. Investment that would have flowed into U.S.-European integrated systems is being redirected. The wealth destruction already occurred isn't showing in conventional metrics yet because it's happening through foregone investment rather than asset liquidation. When a European company decides not to expand U.S. production because policy is too volatile, that's wealth never created. When an Asian manufacturer builds redundant capacity across 3 continents instead of optimizing for one location, the efficiency loss is permanent, but doesn't appear as a discrete event markets can price. When investors demand higher returns to compensate for political risk, present value of all future cash flows declines. But this happens gradually through multiple small adjustments rather than a single crash. This is precisely the dynamic that made the Great Depression devastating. The initial 1929 stock market crash destroyed wealth directly, but catastrophic damage came from collapsed investment that followed. When businesses couldn't predict policy environment, they stopped investing in capacity expansion. When banks couldn't assess credit risk in a fragmenting global economy, they stopped lending. When consumers faced massive uncertainty about future employment, they stopped spending. Each adjustment was individually rational, but collectively, they created a deflationary spiral taking a decade to escape. The 2008 financial crisis followed similar patterns. Immediate losses from housing collapse were severe but manageable. What turned it systemic was how uncertainty about counterparty risk froze credit markets and caused synchronized contraction in investment and employment. We're watching early stages of that pattern in the trade sphere. Specific tariff threats are equivalent to initial subprime defaults in 2007. They're visible, concerning, but not individually systemic. What makes them systemic is how they reveal fundamental uncertainty about institutional framework sustainability. Once that uncertainty becomes embedded, it changes behavior across the entire economy in self-reinforcing ways. Companies building redundant supply chains permanently increase costs. Countries pursuing strategic autonomy permanently fragment markets. Investors demanding higher risk premiums permanently reduce valuations. None of these adjustments reverse when specific tariffs get paused. At this stage of the cycle, most participants still believe they can navigate volatility through better risk management and strategic positioning. But tactical adjustments don't solve the underlying problem that institutional framework enabling global trade is actively decomposing. You can diversify suppliers, but if every supplier relationship now carries higher political risk, you haven't eliminated the problem, you've distributed it. You can increase inventories, but holding more inventory is a permanent drag on capital efficiency, reducing return on invested capital across the economy. The historical record is unambiguous on what happens next. Once credibility is lost, it takes decades to rebuild, if it gets rebuilt at all. The United States lost monetary credibility abandoning gold in 1971, and it took Paul Volcker's brutal interest rate increases in the early 80s to restore dollar confidence. Britain lost its position as center of global finance through policy mistakes in the 20s and 30s, and that position never returned even after specific policies were reversed. When institutional frameworks fragment, they don't spontaneously reassemble. New frameworks emerge, often after extended periods of conflict and economic dislocation. But they're fundamentally different configurations rather than returns to previous equilibrium. What makes the current situation particularly unstable is we're attempting this fragmentation while carrying record debt at sovereign and corporate levels. Global debt as percentage of GDP is at historically unprecedented levels. That debt was accumulated assuming economic growth would continue, supported by continued integration and specialization. As those assumptions break down, debt burden becomes increasingly unsustainable. Countries can't easily grow their way out of debt when trade is fragmenting and productivity declining. Companies can't easily service obligations when profit margins are compressed by higher supply chain costs and lower volumes. The bond market's reaction this week is instructive. While equity markets surged on the tariff pause, yields on U.S. Treasuries increased, with the 10-year rising 6 basis points and longer duration bonds rising more. That divergence tells you fixed income investors understand something equity investors are missing. Higher yields mean creditors demand higher compensation for holding U.S. government debt. That higher compensation reflects either inflation expectations or default risk, or both. The fact this happens while Trump claims economic success and touts low inflation and high growth suggests bond investors don't believe sustainability of those claims. When the next phase of this fragmentation accelerates, and it will accelerate because incentives align toward escalation rather than cooperation, the adjustment will not be gradual. Complex systems don't fail linearly. They operate in a stable regime until stress exceeds some threshold, then transition rapidly to a new regime. We saw this in 2008 when Lehman bankruptcy triggered cascading failures within days. We saw it in 2020 when pandemic lockdowns revealed just-in-time supply chain fragility. Build-up to these transitions always feels manageable right up until it doesn't. Canadian Prime Minister Mark Carney gave a speech at Davos, receiving little U.S. media attention, but absolutely critical for understanding where this is heading. Carney described Trump's approach as a rupture with an international order based on rules, trade, and cooperation. He stated explicitly, "This way of doing business is not coming back." Carney isn't some fringe critic. He's a former central banker, serious policy figure, telling you directly the institutional framework that enabled post-war prosperity is over. The ECB's Lagarde tried downplaying Carney's speech, emphasizing economic interdependence, but the fact she felt compelled to respond tells you serious people understand he's right. The damage from Davos this week isn't that specific tariffs were threatened then paused. The damage is that every participant in the global economy now understands U.S. trade policy is fundamentally arbitrary and negotiated agreements provide no security against future disruption. That understanding changes decision-making immediately and permanently. Capital that would have deployed into integrated production systems will seek safer, lower return alternatives. Investment that would have expanded capacity will instead build redundancy. Integration that would have increased efficiency will fragment into less efficient but more resilient configurations. Each adjustment reduces total output, increases costs, lowers living standards. The cumulative effect over years compounds into wealth destruction, dwarfing anything from specific tariff rate implementation. This is why focusing on whether particular tariffs get implemented misses entire structural reality. The system has revealed itself fundamentally unreliable. That revelation cannot be taken back.